First of all, do you think the full brunt of these headwinds has yet been felt, including just insurance and other costs that are getting more and more attention, like in the Wall Street Journal today?
No, I think right now there's a lot of kicking the can down the road for commercial office buildings, for example. And I think there's a lot more stress coming there, much more stress coming in the apartment sector because of the nature of how those assets were purchased. I mean, the market as a whole ran towards, or investors ran towards apartment buildings because they thought they were safe. People were going to pay their rent. People were paying their rent. And it was a dependable income stream. What they didn't bank on is if you buy something at 3.5%, 4% cap rates, you're making a bet that interest rates are going to pretty much remain historically low. They are not now. And what's happening is those investments are upside down, wiping out equity and beginning to take inroads in terms of depleting the value of the mezz debt. And so ultimately, there's going to be a lot of stress there as well.
Which is awkward if people were hoping apartments could bail out the office sector, not that the remodel of those buildings is easy or that a lot of people are signing up to do that either.
Well, I think there's an opportunity there. We're getting ready to launch a strategy in that area to convert office buildings into apartments, into hospitality, and into some affordable housing in various parts of the country. I think that there is an opportunity for that. You have to reset buildings, though. Buildings, I mean, you cannot take a 300, 400-unit apartment building in New York City or Washington, D.C., where there's some forms of rent control, and raise the rents in 1 year. So, but you can take a brand-new building, reset the rents to what the market is at this point in time, and then also take advantage of some of your cost basis. I mean, converting an office building into a apartment building under the right circumstances will result in a much lower cost basis than, say, an investor who purchased an apartment building in 2020.
Absolutely. We were talking or sort of teasing earlier that there's kind of one city you're watching that you expect a wave of defaults, and if so, you're going to pounce. Which one is that?
Well, I think San Francisco. San Francisco's, in fact, when I was on the show a couple months ago, I thought San Francisco has a lot of opportunity going forward, and it's beginning to happen. The buildings are going back. They're being sold now. And so I think that's the first to come out because it's gotten the worst. I think New York City has to get a little worse, and it will. And then I think there'll be opportunities there. Washington, D.C., though, is the real hidden market because the federal government leases over 40 million square feet of office space in Washington, D.C., and occupies another 25 to 30 million. And they're at the peak attendance in their office building is 25%.
So what's going to happen to all of that real estate?
Well, those government leases are long-term leases, and investors always look at them as like bonds. However, there's a fine print. They're all subject to annual appropriations.
Oh, geez.
Congress is getting ready to close down the government. They're ultimately going to be looking for places to save. It makes they wouldn't cancel leases or not appropriate if the space was occupied.
Right.
But if they're sitting at 20% occupancy, then they're going to start canceling and consolidating. So there's going to be tremendous stress, in my opinion, in Washington, D.C. for these government buildings. And then, of course, the businesses and the professional services firms that do business with the government, you're going to see some contraction there. So I think D.C. is probably going to be worse than San Francisco in many regards in terms of office fundamentals.
Wow. OK. With that kind of bombshell for people to contemplate, what about we've just sort of two D.C. things I want to quickly ask you about. The one is the shutdown. I don't know if beyond that, if you really make much of what's happening or if you're hyper-focused on any aspect of what looks like it's going to be a drawn-out fight for years to come over the deficit and debt levels.
Look, I'm from Washington, D.C., and I started our company in Washington, D.C., and have done business there for almost 40 years. And they have had shutdowns. They come and go. They're political stunts, by and large, because they're brinksmanship. And what happens is we're in a very highly polarized political environment, and so you're going to see Congress, kind of continue the battle. So I think we'll see a shutdown. I think it'll be short-lived. And I think the reality is the government needs to cut its spending. It cannot continue to rely upon all of us to fund some of these absurd expenditures. And so I think they're going to have to prioritize, like all of us have to do in our households and our businesses.
It's going to be tough.
Revenue's down, we got to prioritize.
So then what do you make? The president's out on the picket line right now, obviously. The UAW strike is one of many that we've seen across the country. What do you think as a business owner watching it all play out? Well,
as an American, it's a very bad move for the president. The president's the president.
To go to the picket line?
Yes. The president's the president for all of us. And this is a capitalistic democracy, and the pillars of our democracy rest on capitalism. And therefore, he has to be supportive of all of us. And what he should do is, like every other president does, is relies upon private sector, the business, and the workers to work together to come up with a common sense solution. He panicked, and his people around him panicked because Donald Trump is coming there tomorrow. And so what he did is he broke presidential protocol, and he is showing up there to walk the picket lines. It's not presidential. It's not what leaders do, and it's a mistake.